Hey all, Commerce with MAK here today with another video. Today we are going to learn chapter number 1, Unit 1, Accounting and its needs. This is grade 12 A-level accounting. I have a new update to say you that I'm going to upload 90 days, 90 videos at a consistent basis where I will be teaching you the entire A-level accounting in just 90 days. So stop going to classes, just follow the Commerce with MAK channel, subscribe the channel to learn with me more. I am very sorry that I couldn't put or keep up my word on putting the videos on time, but then due to some personal reasons the timings has changed, and I promise you that I will be uploading every day a video related to accounting, and we'll finish this entire topic. After these 90 days I'll be moving on to the different content which I can. So let's start this first topic, unit 1, accounting and its needs. So this is one of the important chapter, and most of the time tested in your MCQs in your A level accounting, most of the time for 4 to 6 marks on your A level paper. So it's a important area which, if you ask me, then of course knowing the basics is very important. If you know the basics only, we can go ahead without any problem. So now you can see here accounting and its need has few things we are going to learn today. One is the introduction, objective, and also we have stakeholders. So let's see what is the introduction, what is accounting first of all, and what are these type of organization have issued about accounting. The good thing of these videos which I'm going to put in future, every slides which I'm showing you here, you can download it under the description below. And also one more thing, one more update before we move on to the chapter. I have taught you entire A-level business studies. That link of description of entire A-level business studies is also below the description of this video. So let's move on to the topic today, accounting. What is accounting? So there are two organizations which we are taken as an example. American Association of Accounting is saying accounting is the process of identifying, measuring, and communicating economic information to permit informed information and judgments and decisions by the users of the information. In basic terms, why do we do accounting? We need to know when we run an organization, when we run a company, we need to know how much records, how much sales we are making, how much expense we are going through. Is these informations are correct or not? Where is our business actually standing? So know out what our business is going to go ahead in future, what are the problems they're going to face if they don't have cash, is what we say accounting. So you do. American Institute of Certified Public Accountant, AICPA, is saying accounting is the art of recording, classifying, and summarizing in a significant manner, and in terms of money, transaction, and events which are part at least of financial character, and interpreting the results thereof. So understanding what your business is going through, knowing what are the expenses, what are the revenue amount of targets, dividing, classifying means dividing, recording, making it in a very shorter manner, summarizing it into a very short way where you can understand it when you look back, is a part of AICPA's definition. So now accounting, as I said, they can give different definitions, but then you need to know this is the definition which they will expect you to answer on exams. Therefore, accounting is the process of providing relevant economic definition to the concerned stakeholders to enable them to appropriate decisions. So now, who is this stakeholders? Remember one thing, guys. Stakeholders are the people who are getting affected and who can be affected and who are relying on the company's financial statement. So they have interest on the company's financial statement, they have an interest on the business, and also they are getting affected. So if a person is getting affected and also have an interest on the business, then we say it as stakeholders. So these parties can be different type of people. Now there's a question you might have: stakeholders and shareholders, are they same? They are not the same, because stakeholders are the people who are interested in the business and who are also getting affected by the business decisions. But then shareholders are the owners of the company. So shareholders can be stakeholders, but not all stakeholders can be shareholders. So we move on to the next slide to explain you better objectives of accounting. So we have few objectives of accounting. Why do we need to do accounting? Recording of transactions, ascertain business results, ascertain financial position, communicate to end users. Now these terms might be very new for you all, but knowing the terms is very important when you're learning the chapter number 1. Recording of transactions. So when you do a sale, when you have some sort of expense to pay, the basic day-to-day programs, you are recording it in your books, is what we say recording of transaction. Whatever is happening, you should record in related to financial things. You can't record if your manager is sad, okay, manager is sad. If your wife doesn't speak to you, your wife doesn't speak to me. Or maybe if your mother scolds you, mother scolds me. You can't write these things in your accounting books, and of course it might be a wrong thing. So you should be very concerned that when you are recording of transactions, you should record only the financial terms in which is related to the business. Second thing is ascertaining business results. So from recording the transaction, you can evaluate where this business is actually leading to. Is it having a profit or is it having a loss? Then a certain financial position. What is the situation of the business? Do we have enough cash to run the business or expand more, or do we have no money, or we need to get some sort of money from outside to run the business? So financial position is about the sound knowledge of the business, how much they have in order to run the business, or in other terms we say it as liquidity. Liquidity means the amount of cash available to run the business along with the other type of expenses. Now, for example, you might learn something called asset equal capital plus liability, which you should have learned in your O levels, but just I'm reminding the same thing. Ascertaining financial position is where you are comparing your asset with the capital and liability and saying that if your asset is greater than your capital and liability, then of course you're doing a great business. But then when your liability is exceeding than the asset, then you are not doing a good business. Communicate to end users are the shareholders who have invested in the business, not only the shareholders, even stakeholders fall into this category. So satisfying those stakeholders is a part of this communication. So let's move on to the next slide. So I might be speed in explaining these terms, but then guys, we are doing a 90-day program, so we need to be very quick and efficient in learning the things. And if it is very straightforward things, of course we don't want to spend much time on learning these very easy things. But of course, if it is a very hard topic, I will take hours and hours and explain these things very deeper. So who are the stakeholders? A stakeholder is any individual, group, or party that has an interest in an organization and the outcome of its actions. So when I say these actions, these people of stakeholders are getting affected or having an interest on the organization's business activities. Now, who are these people? You can see the main internal people who are getting affected are owners, leaders, and employees. Owners are the shareholders, employees are the people who are working in the company, and leaders who are the directors, managers, those people we can say them as directors. So I mean leaders. So these people are internal stakeholders and external stakeholders. Now these internal stakeholders you can control. Like for example, if it is within these premises, I can control. I can actually take this globe out here. You can see I can take this globe. But for example, if I take external stakeholders, this is not something apart from this control. Apart from this video camera which you are seeing me, I can't go outside and explain you. That is what we say external stakeholders. These people are there with the business, but they are externally apart from, and you can't control them. They are outside the business, but because of your activities they are getting affected or they are having an interest on your business. Now moving on to the topic, we want to discuss who are these people who are outside. Now we can also say these owners are there. Okay, owners are, so you said owners are shareholders. How come shareholders come inside as well as outside? Now there are the people who are starting the company are known as the owners. So they can also be the shareholders when they are selling the shares within a certain private limited organization. But when they move on to PLC, like a public limited company, they sell their shares to outside people. That's the reason these owners become shareholders in external stakeholders. So for now, remember one thing: owners are the internal stakeholders, shareholders are the external stakeholders. So shareholders, why we consider them as external stakeholders? Because they are selling shares to the outside people, because they can transfer their shares to anyone on the public. Then we have the government, who is getting much concern about your accounting, how much taxes you pay, what are the ways you are making revenue, is it in a legal way or in a illegal way. Shareholders are concerned about the return of profit for the investment they are making. Employees, families are so concerned about the money you are making every year, what is the amount of money and how much bonuses these people will get, are so concerned about this. Now these employees families, why they are concerned about the employees bonuses? Because if employees have more money, only they will spend to their family. So this family is also dependent on the income what you provide. Then we have the society, because when you are earning good, then of course poverty won't go down, living standard might increase, the entire economy will have enough resource to take their day-to-day life without any hassle. So that problems will not come only if their internal stakeholders are satisfied. Then we have the community. No one will damage or tarnish the reputation, I mean pollute the environment or by your activities, if you are affecting the entire environment, then of course that they will also get affected, the community. Then the suppliers, why suppliers and customers also being targeted as external stakeholders. Suppliers always see how much is the bid, what is the amount of money you will be paying and how fast you will be paying for them. Based on your financial stability only, the suppliers will do business with you. Customers always say that if it is an awesome brand, for example, if it is a brand like iPhone, then of course you feel like it's a branded thing, then we need to purchase more and more from these customers. But if you do not have, okay guys, don't think that I'm showing off. I just took this phone as an example for you to show that customers are brand oriented. So I'm also a customer, so I'm a brand oriented person. So we consider them, customers can be a person who will be only purchasing if they have a good brand rather than a business emerging into the market. So these people are also getting affected because they are stakeholders and they are relying on you based on your brands, and also the price you charge is also a part about this stakeholdership. Now you can also ask me, sir, if customers are so concerned about the brand, if customers are so concerned about the prices, why they are concerned about the financial statement? Because they should say that this business what I am doing transaction is a very profitable business, so they can bring word of mouth a lot of customers to the business. So they are very, very important because they will drive the business anytime out or inside the market. So we move on to the next term. We're going to see interested stakeholders and their information of these stakeholders. What are their interest? And you can see owners has a satisfactory profit being made in accordance with the investment. Should further investment be made? So do I need to make more investment to get a return out of income? And then management says, management, which is the directors and managers, decide, are plans being implemented appropriately? Are we putting the plans properly? Are we getting a return on the plans which we are doing? What are the necessary plans, decisions for future development? What ways we can ensure that we have enough plans and decisions for the future development of the business? Employees thinking that, is there stability of employment? Is my job safe? Can I get a fixed income every month? Will they keep me out of the company? So this type of concerns are a part of employment. Is the business able to increase wage salaries? What are the ways they're going to increase? How much bonus schemes they're giving? These are concerns of the employees. Then the fourth thing is the government institution or tax department. Are taxes being received on due dates? Are relevant reports submitted to appropriate entities? Are quality goods available at reasonable price? So government always look, are you doing the business in an ethical manner and you are paying taxes on time or not? Then the fifth one is the customers. Are goods of good quality provided at reasonable prices? Does the organization have a reputation and ability to honor their commitment? Are they providing in a good price and customers are purchasing it or not? And also the brand, as I said, the price and the financial stability of the business is very important for the customers, because to bring more people into the business, you need to have a very sound, very financial stable market. Like your accounting should be so perfect to the level customers should believe you that it's better to do business with you. Creditors and lending institutions will see how much money you are creating. Based on that only they will be providing you money, because if you don't create enough profit, they won't give you credit anytime any more in future. We can also see, can the monies lent be recovered? Is it feasible to extend further credit loans? So these are things they will be considering. So we are going to move on to the next topic, very important part and highly tested on your MCQs, the difference between financial accounting and management accounting. Yeah, so we'll move on to the topic, financial accounting and management accounting differences. So let's see what is the actual difference between a financial accounting and a management accounting. So I have given you the very easiest way of understanding. If you notice that preparation of information about the past transaction of an entity in a manner that will enable external persons to make accounting decisions is financial accounting. It's not if financial accounting, is financial accounting. Process of financial accounting has few things: input, process, output. So let me explain you in easy way. If something has happened already and you have recorded it, that is what we say financial accounting. If something is to happen, then forecasting what might happen and the budget is known as management accounting. In easy way, for example, maybe yesterday you made a sale. Okay, so that is yesterday you made a sale, maybe 50,000 rupees. That 50,000 rupees you made yesterday, it's a past transaction, so it falls under financial accounting. In future, maybe tomorrow you'll make a 100,000 rupees sale. You are expecting. So that expectation falls under management accounting. So management accounting is forecasting, financial accounting is going back and taking the past and deciding the record. So financial accounting prepares financial statements. Management accounting prepares budgets, reports, variance analysis, most of the time forecasting things will be done by management accounting. So management accounting is also an important area in your A level. I will teach you on grade 13 when we will be learning a lot of areas. So now what is financial accounting? You have inputs, you are taking the transaction and events, and then you are taking it as an input, you are processing it. Under that, how do you process it? You recognize and measure, is it financial, and you take it, you record it, then you classify based on the group, maybe is it an asset, expense, capital, liability, income, then summarize it. Maybe you put in the trial balance, create the financial statement, finally you present it, summarize, like you put it in a balance sheet, and then you interpret it. So interpreting means like saying what are the financial position of the business and how much financial stable business is, and the final outcome is the output financial statement. So as I said, once you summarize, you get everything, like you can interpret easily. The final thing everyone is expecting from an financial accounting is the financial statement. So with that, we are moving on to the next topic, management accounting. So what is this management accounting? The provision of relevant accounting that will assist and support all levels of management to plan, control, and make decisions in order to fulfill their responsibilities in management accounting. So process of management accounting has input, process, output. As I said, management accounting is about planning which will happen in future. And also you can see when I said which will happen in future, I have a term, plan, control, and make decisions. So you are having a plan, and then you have the term control. You can make decisions, and also you ensure that these responsibilities are carried in a proper manner, you are achieving it or not. So input, historical information, budgeted information. So you take the past data, you take the future data, you process both of that, and then you plan, you budget, you control. Then finally you get few outputs as budgeted statements, accounting ratios, common activities in analysis, marginal cost of information for investment decision. Now these topics you are saying, budget statement, accounting ratios, common activities in analysis, this everything which you are seeing it as an output is going to be a chapter in future when you are studying grade 13. But now you need to remember, management accounting is about planning, controlling, and making decisions, and in future, so management accountants will be always relying on the internal parties, and like they will always have a control between the internal people. They're not going to satisfy the shareholders, because shareholders main part is financial statement. So if you take financial accounting, the accountants who are preparing financial accounting, their main responsibility is to speak to the shareholders and satisfy them with the records what they have. But management accounting is not like that. Whatever the internal things, like directors have some sort of reports to be generated, these people will do internal. So these reports are not for outside use. Like financial accounting, it is represented for all the people. So almost like internal stakeholders, external stakeholders, all rely on the internal, all rely on the financial accounting. But management accounting is not the same way. It is all external people, it's all internal people will be so concerned about management accounting, whereas financial accounting is all external people like shareholders, customers, suppliers, even internal as well as external you can consider. Then we move on to the next term we are going to speak. I'll erase this off. Clear. Yeah. So then we move on to the differentiation of financial accounting versus management accountant or versus management accountant. Financial accounting uses historical information only, whereas management accounting uses historical and budgeted information. Financial accounting provides information for internal and external users, whereas management accounting information is provided only for internal users. As I said, information is provided for a specific period of time. Maybe you will prepare for 1 month, 3 months, or 6 months, or 1 year. But whatever it is, guys, you will be having a specific time period of time. Here you will moving on to the next part. Provide information as and when required by management. Whenever management needs a report, you need to prepare that quickly. So you can't just postpone it, because it's a report which is needed by the management. Follows accounting consent rules and regulation, following the government rules, most probably Sri Lankan accounting standards. But then here, not required to follow accounting consent rules and regulation. You can prepare the report as per your convenience. So that is what we say management accounting as well as financial accounting. So we're going to move on to the 1.1 which I'm speaking today. This contains objectives. We learn about accounting objectives. Then we learn about how to record these accounting parts. Then we spoke about objectives of accounting, stakeholders, types of stakeholders, their interest, financial accounting, and management accounting. Now we are moving on to the topic financial events and non-financial events. So let's check what is a financial event and non-financial event. If you say a financial event is where economic factor is basic financial information. Any transaction related to finance we said as financial events. I can go deeper and spend time, but of course I don't want to do that because you are getting for your exams and you wanted to learn things faster. I don't want to go very slower. If my explanation is very fast for y'all, play it in one. There's a system in YouTube. They have given the speed changing part where you can make one as 0.75 or 0.5, so you can watch this video in a very slow manner. Economic factor is a basic financial information. The profit of business is rupees 200,000. The total asset of the business is 2 million. The gross profit of the business is 500,000. So whatever you can calculate in finance and also in monetary terms, we said as financial events. But non-financial events you can actually take under financial things. You can see factors that are not financial in nature but also important for decision making of stakeholders. Example, the workforce of organization is 500. The business had a good reputation for marketing of goods of high quality and good condition. The company has a good procedure of employee motivation. It's not God, it's a good. Okay, so there are sometimes one or two words might be different, but when you are downloading the tunes and printing the tunes, watch the video and change these mistakes, because I do not have time again to upload the video saying these are the mistakes which we have in the tune. So one or two spelling mistakes might be there, but not other than that. So what is non-financial events? Non-financial events is where you can consider based on the quality of the business, maybe the reputation, the quality they are providing, the satisfaction the customers get. We can't take it into financial events, but this will affect the accounting, because if customers are happy, they will make more we can make more sales towards the customers, and good reputation will bring more sales also. And like, if you have a good procedure, employees will be motivated to work with you, and also if you give good bonuses, still employees will be so having a good morale to work with your company. Then that will increase the level of productivity, which will actually contribute to the finance of the organization. So let's move on to the last topic. It's a summary which I have given for you on 1.1 unit 1. Milinda commences service organization in media and communication, having made an initial investment of rupees 200,000. That is financial event, because I mean financial transaction. You can see all transactions related to the business have been recorded as given below. Loan transaction recorded in loan register, cash transaction recorded in rough cash book. Personal information about customers is recorded in a separate book. So customers information can be a non-financial transaction, whereas loan transaction, cash transaction can be a financial transaction as well as financial accounting, because you are recording the transactions. 2 years later, based on the responsiveness of customers to its services, Milinda decided to expand his business. Now this is management accounting and also non-financial transaction, because customers are responding to your business, so you are expanding the business in a greater scale manner. For this purpose, a further capital input financial transaction 150,000 was estimate requirement. So estimating, like budgeting, planning, is a management accounting concept which was proposed to be met with the bank loan. The bank has informed that they require financial statement of the past 2 years in order to provide the sum as a loan. So financial statement preparation falls under financial accounting. Okay, so before we finish this video, I want one more thing to show. This is a question which I have given you. Attempt this question. If you do not have any idea on this question, ask me. I can comment and give you the answers through the comment section. Respond to the questions. You can ask any questions through the comment section. I will always help you out. And also guys, if you really like this video and you want me to put more videos, subscribe the channel, support me out to put more videos and contents. See you guys on the next video 1.2, accounting and its environment. So this is accounting and its needs, this chapter 1, and we learned a lot of things on this chapter. In chapter 1, 1.2 I'll be doing on the next video. See you guys. Have a nice day. Bye.